No, I'm not familiar with the group. 2030 depression.
Yes, it's
4 years from now, you're picking a depression. Are you kidding me?
Welcome back, December 17th. Very excited for this. It's been 4 years since we've done this. Author of Stocks for the Long Run, professor from Wharton, and now senior economist at WisdomTree, Jeremy Siegel. All right, Professor, before we move into 2026, let's go back, 2025, we're still here. What is really some of your biggest takeaways from this volatile year that'll help us move into how we frame 2026?
Well, certainly the tariffs did not have the fearful effects that we all had worried about. And that mainly is because it was scaled back quite significantly from the April rollout that sent the market virtually into a bear market. I mean, and then once they determined that Trump was backing down on the worst ones and deals were being made, the market could look forward to all the positive aspects of the Trump administration, which is certainly the tax bill, which is very favorable, less regulation, a much friendlier view of mergers, and those positives offset the negatives of the tariffs to send the market to new all-time highs this year.
That's what surprised me the most too. I'm curious what you think on. I thought the market would have been ready for the tariffs. Now I know that we went higher, much higher than the past, but the first playbook, the Trump 1.0, it was the same thing, harsh on China, pull them back a little bit. But the markets, the knee jerk was down even harder than the past. So it's almost as if we're repeating the same thing that I would have thought we would have moved past a little bit.
Well, don't forget that I think the tariffs the second time were much broader. And don't forget, I mean, at one point we had a 125% tariff, virtually an embargo on China, which, would have been a disaster. And there was, then China put 125% tariff on us. So we didn't have that sort of battle. And there was worry that there would be battles on some of those other fronts. Well, it turned out when I think I began to really see the light when Bessent went to Switzerland in the first negotiation with Xi, and Trump had said, I think a 50 or an 80% tariff just 2 days before is the right one for China. Bessent called in from Geneva saying, hey, they're offering 30. And Trump said, okay. Yeah. And I said, okay. This is not anywhere going to be. I mean, it's totally a bargaining chip, and the fears of the market that it's going to be 50 or 80, which I think would have really been damaging to the economy, is not going to happen. And that started the bull market, really. I mean, it did come up from the April lows because the market reaction was so bad that he, was put a 90-day delay. But then when he came back with China with 30, people began to say, okay, this is going to be bargained down. And I think that started the bull market that we see today.
Hopefully you're enjoying this interview. If you haven't done so, hit that subscribe button, because next month we're going to talk about ITR and their 2030 call. We're going to go through the structural components that they have and give our take. We know what Jeremy's take is on that. If you haven't hit that like button, make sure you do it, and make sure you hit that button and share. And if you're not following us on Spotify, please do that so you can listen to us on your drive home.
Last year we did this with Jeremy Schwartz, who you obviously know very well, and I was pretty excited to talk monetary policy. And I start there, and he said, no, this is the year of fiscal, and he nailed that this was going to be something where we're just constantly watching what's coming out of Washington. Do you think that's going to happen again in 2026?
Well, don't forget, monetary does come still out of Washington. We're going to get a new Fed chair early next year, named, and that is certainly of significance, monetary-wise. As you know, I have been for the last 6 and 9 months saying the Fed should be lowering interest rates. I think that interest rates should be short-term Fed funds rate should be in the low threes. So we're saying 50 basis points under what we have today. And I think that Chair Powell has been slow to get there. I thought the worries of inflation were outblown because they worried about tariffs, which you shouldn't worry about it anyways, because it's a one-time tax. And the other factors are coming in pretty favorable on that inflation front. So I think the Fed could move down there now. Whether it takes 6 months or 3 months or whatever is, perhaps a secondary issue. But I think we will get down into the low 3 range next year.
Yeah, the market's not really expecting that. If you look at, you quote Fed funds futures all the time, it's 1 or 2 cuts next year, not, I know you're saying maybe 3 or 4 potentially.
No, not necessarily 4, because we're already, we're in the 3s, right? I'm sorry, 2 Fed cuts does get us, I think, below 350. Is that right?
Yeah, we're at 3.5 to 3.75 now.
Yeah, so that would get us there. I mean, so as a result, we a couple cuts. I'm not saying, we heard Trump say, they say, well, what do you think the right rate is at 1%? Well, it ain't going to 1%. And that's definitely the wrong rate. But my research, I looked at the spread between the 10-year and the Fed funds rate over the last 75 years, and the average spread has been 109 basis points. So let's say 1 percentage point to be just, rounding it off. What do we have right now? We have the 10-year at what, 415, 414, and that puts you, in the 3 to 3.25. I wouldn't mind 3.25, 3.5, but it puts you into the low 3 range. And that's what we have a normal term structure. We should have an upward sloping term structure. I think certainly that's where it's convenient. Also, the fact we're going to see how much slowing of the economy we have. Because of the dearth of data, we have no estimate really on this fourth quarter yet. However, the data that is coming in seems like it's okay. But we do know that the government shutdown did delay a lot of things and took perhaps 1 or 2 percentage points out of the GDP for the fourth quarter. We get the first estimate for fourth quarter 2 days before Christmas, actually, that from the Philadelphia, the Atlanta Fed, the GDP now estimate will come out on December 23rd. Which is certainly the latest we've ever had an estimate for the current quarter. So that will be coming out next week.
Warsh, Hassett, Waller seem to be the 3. Waller was falling off a little bit, and actually today they announced that there's going to be some sort of interview with Trump. You said it matters which one to the market. How do you think about those 3? My choice,
I think all 3 of them are fine. But if I had to pick, and I've said this a while, I would pick Warsh. He has the institutional background. I know Kevin Hassett very well personally. I worked with Kevin Hassett actually on the John McCain campaign in 2000 as one of the lead economists for McCain with Kevin Hassett. So I know him, and he's a delightful person and a good economist. But his expertise is not in the monetary theory area and monetary policy area. So although I'm sure, he could be a quick learner, and don't forget, let's face it, Jay Powell had no experience also in macroeconomics at all. He had very little experience in economics. He was, in private equity. So Kevin Hassett has even more experience than that. But Kevin Warsh has the history. I like the way what he has said in terms of understanding the role of the money supply, in terms of looking at the tightness and the restrictiveness of the Fed, I would feel most comfortable with him, but I would not feel uncomfortable with any of the 3 choices that Trump is considering.
Professor, are you familiar with ITR? It's like a CEO forum. And they go around nationally and talk for the Vistage, and they have this call on a 2030 depression.
And no, I'm not familiar with the group. 2030 depression?
Yes, it's
4 years from now. You're picking a depression. Are you kidding me?
They've been doing it for longer than 4 years from now. It's been a shtick of theirs for over a decade and by coincidence, they're just retiring and they're transferring control of the company. But it gets a lot of play with CEOs and other people that are in C-level suites because of just they have a nice story. Basically, they're projecting out demographics, they're projecting out the debt limit, and they are saying that sometime in the early 2030s, it is no longer sustainable and that there would be a correction. I would agree with a lot of the structural problems that they're pointing to. The conclusion is where I kind of leave and depart from them because we have this ample reserve system, and I think they're still working out of a 1930s type of component where you would have a contraction in the money supply. And people are coming to me, the reason that I even care is because they're concerned and wanting to go to cash.
As we get closer.
Well, let's talk about this.
Yes.
Let's talk about a number of these issues. First of all, I've always been one to say there is no debt crisis now, certainly. The bond market will tell us when there's a debt crisis, when you start seeing the 10-year really rise. And there seems to be still a huge appetite for treasuries around the world. Also, one should realize that treasury debt is only one part of debt. Do you know that the debt to GDP ratio right now is actually lower than it was before the financial crisis if you had household debt, corporate debt, state and local debt, and other financial debt? It's just the federal debt that's going up. The rest of the debt is actually lower than it was back then. And I've looked at various aspects. I'm not saying that eventually, unsustainable path, but, we've heard this Chicken Little story for 20 years. We had, Simpson and Bowles going around right after 2009 financial crisis saying the world was going to cave in. That was 17 years ago, right? I mean, they were very popular as they went around the country, drawing hundreds of people. They were bipartisan, talked about the unsustainability of the debt path. They're no longer around, nor do they talk about it, because none of that has happened. And in fact, since they started talking about it, the interest rates on the government debt went to all-time lows, which is totally opposite of feeling that there's too much debt out there. It was like too little debt relative to the demand. So, the problem, yes, some century these people will be right.
Stop clocks are right twice a day.
Right, twice a day. Other people are lucky if they're right once a year. Others once a decade, and then some once a century.
And I agree with your investment philosophy, stocks for the long run, ride this stuff out. But to steel man their argument, the reason interest rates are low and the reason that our treasury can be floated is because there's demographic shifts where you have a large part of the population that is still large income earners, the baby boomers, as they're dropping off and starting to have less of a demand for the treasury, there isn't anything in a gap that's coming up to fill that because of the demographic problems, so that we would see this turn out. So I have my answer to that, but what would your answer be?
There's two things going on here. First of all, you're talking about demographics around the world, are you, or are you just in the United States? I'm not.
They would consider both of them, but they're specifically talking about the U.S. demographics.
So population growth won't be as high as before. However, the demand for goods and GDP and securities and treasury debt and everything like that depends not only on the number of people, but how well off the people are. So that means that GDP is the product of not only population, but population times productivity. Do they see no increase in productivity over the next 10 years or 20 years? Do they not think that, AI might accelerate productivity like many economists do believe? I do, which I think will produce real GDP growth the same. So we may be down on population growth, maybe 1 percentage point, but we can increase GDP by 1 percentage point through productivity growth.
Agree with that. I would also add that the demographics are not the only thing that supplied debt, and we've gone through the 1930s, we've gone through 2008. There is an ample reserve policy, politically, you're not going to have the U.S. default on its debt, which is what was be required to have a 1930s depression, because it's just not sustainable. You're going to have to fill that gap with monetary policy. There just isn't the political motivation to ever default on that.
No,
So
you'll
the
never
problem
default
would
on
be
the debt. You will
inflation.
never ever default on the debt. There'll never be a failed auction. You'll never default. Secondly, I mean, we learned from the Great Depression that you gotta supply reserves if there's any crisis. I don't. First of all, what's the crisis that it's going to do? I mean, if they're the interesting thing is it's not deflation that is the problem of an unsustainable government debt path. It's inflation. If you're talking about inflation, stocks are one of the best hedges you can have. You need real assets. You don't want money. You don't want cash. Why would you want cash if you had inflation?
That's why when I read your book and when we have those conversations with clients, whenever that fear happens, people use the word stocks or equities. I always like to just say businesses. Your businesses who can pass on the cost. It helps reframe that.
Equipment, ideas, copyrights, trademarks, all that. That's real assets. You do if you're on an unsustainable debt path, you want real assets. You don't want paper assets. I mean that's like a given that's been shown around the world. You talk about the banana republics that have all the spending and they have unsustainable debt and they just print the money, and there's inflation and everyone that holds land and capital and all that are fine, and everyone that holds money goes bankrupt. I mean, that has played itself through history over the last 100 years.
We totally agree with you, so that's why we want you on record saying that no, the strategy is still stocks for the long run, despite the unsustainable debt component that will be right at some point in the next century.
The unsustainable debt component means that you got to own real assets. Now, we haven't talked about property as another real asset, but stocks are just as good. In fact, one of my major conclusions that I reached, 30 years ago, that's been proved again and again, is that stocks are near perfect hedges long-term against inflation. I'm not talking about year to year. I'm talking about in the long run. Because don't forget, since we had virtually no inflation in the United States from 1800 to 1940, and we started inflation after World War II, and we've had almost 3,000% cumulative price increase since then, and there has been no negative effect on real returns from stocks. In other words, stocks have totally ridden that inflation to give the people the return that they need after price increases. Bonds have not done that. Bonds cannot do that. TIPS are the only thing that could do that. And even TIPS and first of all, their yield is terrible. It's 1.8. And secondly, they have a lot of flaws in and of themselves. And in the case of a hyperinflation, they're almost also worthless because of the delay in the indexing process. So if you're really worried about a big increase in inflation, you don't want TIPS either.
I'm glad I'm in your corner on this. And I know Chris is probably wanting to get back somewhat to our outline. We know what you're saying long term, but what about 2026?
Well, there's a lot of places to take. I did check too. It was 15 minutes is how long it took for someone to say AI, which was a record for 2025, which I like. And we don't even have to go there because there's enough. You're doing labor forecasts for the next 5 years. I want to hear what you think about labor next year, because you did reference at the beginning a little bit of softening that you're seeing, and curious if you think you'll see a reacceleration in labor in 2026.
Well, we're seeing, softening in demand. I mean, this is a very unusual economy. I mean, it's a no hire, no fire economy. The unemployment rate has crept up, but jobless claims have remained well tamed, and it is actually very, very unusual. And part of it, of course, I think, is the squeeze on immigration, from way too much to, you can make a judgment. Some people think too little, others think it's just right now. But the facts are that the supply of labor, which was going at 250,000 per month, now is going probably at most 50,000 or even below. because and there'll be jobs, for the American laborers. And then there may be some higher prices, but we don't see it in increased wages. Actually, wages have been very well tamed. So, that's good. I don't see inflation. Yeah, we're seeing lower population growth, but again, I mean, this whole idea that that's going to cause the economy to crash. Actually, if you think about world resources, the less population growth is probably good for the supply of world resources. We need to be able to substitute technology for human beings in that sense. Now, there's another issue. I mean, there's another issue that many countries in the world have dropped below replacement level. And what does that mean? But that's going back, we're talking about 40 or 50 years. Maybe the population will be 1/2 or 1/3 around the world, and we could talk about that as another situation. But just population, population growth used to be, oh my God, we're going to run out of resources, it's going to pollute the world, everything is going to explode. And all of a sudden now, when we control population growth, oh my God, things are going to collapse, there's going to be a crisis. I mean, it's like a crisis for these people either way. I mean, what are they, like, this way, oh, it's terrible. Okay, then we do that. Oh, that's terrible. I mean, these are people that don't seem to have a model.
You talked about, I want to get this back to asset classes and expectations, and really we can close it out there. You mentioned property, and typically I hear you talk a lot about stocks. I know you wrote about commodities and gold, and I know WisdomTree actually just got into some land and has acquired a farmland provider. So I'm curious how you think about just alternative assets outside of public markets.
Well, real estate is a huge asset class that really rivals stocks worldwide in terms of value. And it's really huge. Now we have those REITs, real estate investment trusts. I added a lot about real estate in the 6th edition, Stocks for the Long Run. The interesting thing is we have 50 years. I'm talking about equity REITs. I'm not talking about those mortgage REITs that mostly went bust. Just talking about the real equity REITs. The interesting thing is over the last 50 years, those equity REITs have virtually just fallen short of matching the S&P 500. So real property has done well on rental, and of course, if you have farmland, that's crop and it potential of development later on. So diversifying into property. Of course, everyone owns most people certainly listening to this podcast probably owns their own home or another property. So you have to look at your wealth there. But certainly a chunk of your wealth should be in real property, either farmland or undeveloped land or their own homes. That should rival it, or REITs. And don't forget, REITs are one of the 11 sectors of the S&P 500, carved out about 6 or 7 years ago from the 10 sectors that existed for 30 years. So it is already a recognized asset class. And yes, WisdomTree went into the farm area because it's not only on food generation, but also the potential for whatever development might come from that farmland.
One thing, I don't know if it matters, but when you mentioned the population decline is a scary thing, and it surely, it's something that needs to be addressed socially, but it made me think of the Black Death of Europe is likely the reason that we get the Renaissance and the end of serfdom is because population decline goes down, wages go up, and allowing people to educate their kids. So, because there were more resources now available. Yeah. So we've seen that historically happen where population decline.
Like that happened in a year or two versus this population decline, which is decades long. I mean, although I think Japan and a couple other countries are already, even China now, realizes the mistake of its one-child policy lasting way too long, and now they're in that trap. Other countries in Europe, particularly in the South Europe, are also into that trap. But this is something that'll play out in decades. I wish I could be around in decades. I don't think I will.
We'll have you on. We will still have you on.
This is not going to be a sudden thing. So I think it's beyond, it's something to contend with. And you're right. Real wages went up and it started the end of serfdom. And who knows? I mean, robots will be doing what people had been doing in the previous century.
So let's get to forecasting.
So there's a couple of things why I think there's tailwind. First of all, the tax cuts really kick in. Secondly, expectation. I mean, one thing that I think, it's probably the media, I think, that did this. You ask people what their inflationary expectation, up at 4, 5, 6%. I mean, it was ridiculous because they all got scared from the tariffs. The tariffs are not going to produce anything like that. And most tariffs are raising, in my opinion, unless they shoot up again, and I don't think Trump's going to do that, is really a 1 percentage point increase in the price level. So, which we've already beginning to go through on the goods. So I think people will be surprised the prices are going to moderate, and particularly what's moderating, interestingly enough, is property prices, rental prices, which is 40% of the core CPI is in shelter, and those are finally going to be moderated. I mean, year-over-year rentals are flat. Year-to-year home prices, according to Case-Shiller and other indexes, are up only 2%. All that is good for the inflation rate, and all that is positive for how people think about housing and all the rest. It doesn't solve the so-called affordability crisis on housing because still people many people will be priced out, but it certainly is going to go away, and the other inflation is not going to appear, in my opinion. Look at what's happened to oil. I mean, we have a 3-year low on gasoline prices, and oil is at 3-year lows. So, I mean, my feeling is that the lower inflation, lower shelter prices are going to surprise people with the tax cuts. It's going to be a consumer shift, maybe less of the AI build out. There are questions about whether there's too much, what technology is there. So that long sought out rotation that everyone talked about, looks like this. We might really get it in 2026. No guarantee, certainly. But in terms of the macro dynamic forces, I think favor that broadening of the narrow tech Mag 7 rally that really dominated 2025.
Are you calling it small cap? What would you officially make your call?
We like high quality ones where the earnings yield, and we like buybacks plus dividends, not just dividends, because there's so much buybacks are so important. And by the way, we have so much buybacks a lot because of the tax rules that favor buybacks over the dividends. But so we're looking for high quality stocks that have good earnings yields and have good dividend plus buyback, which is sometimes called shareholder returns. We're looking for those to perhaps lead the rally of stocks in 2026. Overall, I think the S&P, it's hard to say. I don't think it's going to match 15% this year or the last 2 years, but I think 10 to 15, and maybe the Mag 7 will be 0 to 5. You move out of that, you might get 10 to 15 in those stocks that provide a better shareholder return.
So last year when we did this, Jeremy Schwartz, you probably didn't know this, took the exact same call, took shareholder yield, which it had a good year. It didn't outperform large cap, but it's caught up a lot in the last month as a little broadening into the end of the year.
Yeah, I mean, it was what I thought also would happen this year, but I was not as sure because, it is unprecedented what's happened to growth stocks. I mean, we have 100-year, Center for Research and Security Prices, the FAMA French data on growth and value and how it alternates at 5 years, 7 years, this and that. We have never seen sustained growth outperformance over the last 15 years on growth the way we've had. I mean, it's just unprecedented. So, in a way, you're in uncharted territories, and when it's very hard to call when the end will come. It will come because history shows it. But we've maxed out years ago what had been the longest growth versus value. This year beginning, we're seeing some questions in AI the last month. which surprises me because I thought there'd be a lot of a catch-up trade. Of course, there's still a couple more weeks of the year, but people trying to paint their portfolios year end. But nonetheless, I think the questions of overbuilding, of AI implementation, faster chips that might, not need the type of data centers we have. We could go on and on and on, but those doubts, I think, are showing up more prominently now, certainly than they did during most of 2025.
I might be boring as taking the same call I made last year as well. I took I took the private markets call based on M&A, IPO, just similar to taking a broadening out trade. It's almost the same thing, and it also performed well, not as well as large cap.
It was almost impossible to beat the large cap because the Mag 7 until the last 2 months. Well, and of course the decline in April certainly hurt those large cap, but that was an external, tariff scare. Outside of that, again, they certainly dominated. Now I guess we're seeing an interesting repricing. I mean, it's interesting that Tesla is now the stock that's hitting the all-time high, which has a 150, 200 PE ratio, something crazy like that, and that's all on self-driving. I mean, that could be the first, if you call it an AI use, which I think is in many ways. I think it's the first major big potential breakthrough in AI. I'm not going to debate whether Tesla, is better than Waymo and all that sort of stuff. That's for others to decide. But that, self-driving is one of those potential leaps of productivity that could be much closer than we think.
Last year I took gold and I was right for all the wrong reasons. This year, I would not discount growth, but I'm going to be more value side. I think the infrastructure and the build out and the bottlenecks that we're seeing in AI and the data centers, that they're the biggest winners. And maybe we get to see a value performance just because it's catching up.
Well, that certainly is the case. I mean, I heard from one builder that they said, just to build the data center now is 3 to 4 times what it was 5 years ago. Because, the land and the shortage of materials. I mean, we've already heard about delays that I think a little bit shook the market already about, how fast it could do that. Well, again, it's the same thing about, you want to be the gold miners that sell the pickaxes and all the rest. They're doing well.
Well, Professor, thanks for doing this. Let's not wait 5 more years to do this for our 3rd time.
No, I'm with you every year, and I'll face up to any mistake I make. But I try to give you a sense of where we've been and what I'm thinking of as we face the new year. I'll be happy to talk to you anytime you want.
In 4 decades, when AI saves us all, we'll continue to have these podcasts with you.
I hope I'm around. Don't think so, but I hope I will be.